What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are breaking down how to roll a position, the pros, the cons, what does it mean for you, how can you take advantage of it, and the numbers behind it. So if you were excited for today's video, make sure you like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. Now, what we're going to be looking at is Otis Worldwide. Otis is an elevator manufacturing company that also repairs elevators all over the globe. I have been bullish in this company for a little bit of time recently. They are also headquartered in my state, which is absolutely awesome. So I've heard about them. I've seen them all the time. So I got into them as a result of it. And now what you're seeing here is basically a poor man's covered call. Now, basically, I bought a leap option here for Otis Elevator, for Otis Worldwide at $85 call option that expires in March of 2026. Now, I bought this option here, and I also sold a shorter option of $90 calls as a strike price, basically creating a poor man's covered call. Just as you want to see a quick recap as to how that would work. So I would go out and say, okay, I bought the $85 call option here. I then sold a call option for November at $90. And it creates this kind of, position here where it's a poor man's covered call, because if Otis Elevator goes up, it hits $90, I make $240, almost a 50% profit here. It's like 40%, it looks like. Make about, if it hits $90 a share, I can be able to close both positions out here. And then kind of, if it goes past $90, I start to lose value as a result of it. So basically, it creates what's called a poor man's covered call. There's other ways of calling this. I forgot the other names are. But with looking at Otis Elevator here, or Otis Worldwide, I guess I should say, right now I'm looking at, hey, don't go to $90. And Otis just broke $90. Okay, I had a nice day on Friday. It was up 93 cents. It pushed it over the $90 mark. And now I'm sitting there saying, well, I want to give this position, I want to give it a little bit more room to run here. So I'm going to show you how to roll a position. Now, I can't do it right now because the market is closed, but just as a theoretical roll as to what it does. When you roll an option, the idea behind rolling is that you either push the strike price higher, you can push the expiration date out further, you can push the strike price lower, you can push it sooner. Whatever it is you want to do, you can adjust your position as you go. Now, what rolling basically does is it'll close one position and then open up a new one right away. Okay, so here's my $90 call option right here. Right now, it's sitting pretty down about $175 because obviously it's in the money already, and it's still about a little over a month to go, almost 2 months to go before this position, can be exercised, right? I'm going to go to roll this position here. So I'm going to roll the position here. Now, I want to say, hey, let me go to December 19th. And what I'm going to do is I'm going to say, you know what? I want to give my leap option more room to run, because if somebody exercises this call option relatively soon, my leap has to get exercised to fulfill the shares for this position right here. That's something that's very, very important with the poor man's cover call, is that if this gets called, if you get assigned bump from this, you get exercised, you need to come up with the shares or the collateral quick. And that's why you would have to exercise Otis Elevator, my leap option, to fulfill the order here. But so say I want to roll the position out here, right now, again, right now it's at about November 21st. So say you want to give it a little bit more room to run. So say I want to go to, say, the $95 strike here, right? So I'm going to go to the $95 here. Now, what's going to happen is you're going to see two legs open up here. So they're going to buy to close this one right here. They're going to pay $370 to close it. Then you're going to get paid a new premium of $203. And the difference between these two creates a debit because you're paying more than what you're getting paid out. So it's going to cost you $167 extra to roll to 95 and also have it expire on December 7th or December 19th. You're sort of saying, well, Fridge, why would I do that? $167 I'm paying out of pocket for it? Yes, that is 100% correct. Okay. If you wanted to keep the strike and you really were totally fine with the strike price here, you can just do $425 and get an extra $55 and it pushes out the date only. All that changed here was that you push it out about one more extra month. You can go to the $92.50 one if you want to, and it's going to cost you only $72. But now if it goes to 92 or 93, you'll get exercise as a result of that. So you could roll it to whatever it is you want to. Now, the higher up you go, the less likely you will be, getting paid for, because it's less likely to happen, right? If I go to $100, it's going to cost me $295 here. Now, what would be the reason of me rolling it to a $95 strike price here? Okay, because I'm paying $167. Where's the profit there? Well, let's take a look back at Otis Worldwide and take a look at what happens here. All right. So if this call option here, right? So let's do a simulation here. So this call option here. So if we go to $90, which is what I would be forced to sell my shit to exercise this app by October or by November. What was it? November 21st, I believe it was. November 21st, I think is what it was. This position would actually be simulated to be down about $68 by the time this expires and it exercises and everything else. But let's say I roll to $95 here. And let's go now to December 19th. We'll take a look. At December 19th, instead of it now being down $50-something, now it would be up $200 because the share price would appreciate. Well, I don't know why I went to that one. Do 95. There we go. 95. So you'd be up $282 here as a result. So rolling the option here, rolling it up, yes, I am paying $167 for this to be rolled up. But if it goes to $95 by December 19th, that means that I would have $282 minus the $167 I pay for it here. So let's do some quick math here. I have a calculator here because I don't feel like doing math on a weekend. $282 minus $167, I would be up $115 overall instead of being down $60. So it's a nice way to swing your strike prices. Now, obviously, if I rolled to the $100 strike price here, that would be even better because if I did $100, just like so, and it went to the 19th one, that would be up $743. But again, I had to pay more to give the room for the option to have more upside. So that's what people need to understand. Now, here's the problem with rolling an option like this one. Okay, let me go back to the actual option here for you guys. So if you go to this option here and say you do, not that one, we go to the $90 call option here. So if I wanted to roll this one out here, and now, so here's the problem, right? Let's say that I roll it to say that $100, and I paid $295 for it. Then let's say Otis Elevator sells down to $80, down to $85. Not only is my call option going to lose value, but now this is going to also lose some value too, because I'm paying $295 for the potential for Otis to go higher. But if Otis comes back down, not only is my leap option going to lose value, but I paid $300 extra for it to go down. Like, why would I pay that? So there is risk associated with these kind of plays here. Now, what you could also do with these kind of trades here, so I can find another one here for you. I don't have any puts. I have one put right now. This is a leap put option here. This is a leap synthetic long, which is a whole different thing here on Sweetgreen here. But so let's say that you went to Sweetgreen, right, which has been getting absolutely slaughtered this whole year here, clearly, as you can tell here. And basically what you could do is, so I have a $5 cash secured put on Sweetgreen. It's not till January of 2027, so it's going to kind of sit there for a while, not do much. But let's say that Sweetgreen goes down to $5, and I don't like that. I want to get it at a cheaper price. I still think it has more to the downside as we get closer to the strike price here. You could also roll cash secured puts, okay? So basically what you would do here is that I went to the farthest, so I'm at January 2027. So here's that one right there. But now let's say I want to go till 2028 and I want to roll it down to say the $3 strike price here. So I'll get a whopping $5 in credit. Woo! But what it does is it frees up $200 of my collateral because instead of having $500 put aside to buy shares, I'll only need $300 because I'm buying at $3 instead of at $5 per share. So I get paid $5 here. It ties up my cash for longer, but I get paid $5. And I also unlock $200 in cash collateral. So it's a very, very nice tool to look at as a result of it. You also could roll, what's another thing we could do here? You also could roll a call option like this. You could roll this one up higher if you want to. So say that, you're really, really bullish on Otis Elevator and stuff like that. So say you're saying, you know what? I think that I'm going to roll the $85 one that I paid as a result here. Say I want to roll it up to the $90 strike price here. You'll get paid $320 to roll this call option up. Now, why would I want to roll a call option up? Well, if you really think it's going to take off and go longer, you will actually get paid more because you paid 900, it's worth 930, you then paid 610 for the new one. So the difference in these two is what you get paid out as a result of it. But look what it does is it's going to move that break even price. Your break even was 94.30, now it's 96.10. So if you're really starting to be bullish on a company, some people like to roll their calls up to get paid a little bit more as it continues to pump higher and higher and higher. Okay. You also could roll it down more if you want Otis Elevator to come down a little bit more. You could roll it down and pay obviously a lot more for it if you really wanted to. So if I want to roll it down to the 82.5, I would pay the difference because it's lowering my break even. It's going to cost me more than what I have right now. So right now I have one that's worth $930, but this one cost me at $1,115. I pay the difference to roll the strike down, and rolling the strike down also rolls down the break even, which makes me have a better chance of being profitable. So that's another way you could look at rolling options. Now, rolling options is definitely could be beneficial. It also has the risk associated because, again, if you pay for it and then it goes against you, that's a problem. Because not only does your leap option lose value, but then you also paid for it to lose value. So there is risk associated with it. And also something to keep in mind about, since you are closing one of your positions, if you made money before you rolled it, that will get taxed in your taxable income. If you're not like a brokerage like this one, if you're not in a retirement account, you would pay taxes if you rolled it and you made money as a result of the first one. Again, the rolling position, you're closing one option and then opening up another one right after it. So that's something to keep in mind about. So that is how you roll options here. Thank you guys so much for watching today's video. If you made this far in the video, as always, make sure you like the video, subscribe to the channel, and turn on those bell notifications as always for all future uploads. I hope you're making money in the market in some way, shape, or form. And as always, I will catch you guys in the next video.